Welcome back to the channel, everybody. Today I am joined again by my very, very good friend and colleague, Clayton ASTORE. Clayton is going to walk us through covered calls in this video, what they are, how he deploys them, and why he's always talking about them in the OBR live calls. So Clayton, thank you for joining us today.
Thank you for having me, first of all. It's always a pleasure to share this platform with you, and I couldn't appreciate it more. I love speaking to you on a daily basis, and you make my life a lot easier comprehensively, so I appreciate that. So,
likewise, my friend.
Yes, sir. Yes, sir. So, we're going to get into a little bit of background on Clayton first as to why covered calls are very near and dear to my heart. So, when I first moved out of my parents' house a little while ago, I didn't have a lot of capital. And I did not want to lose the capital that I had trading risky naked options and et cetera. And my risk management just wasn't there. And I was looking to do something longer term, but I needed a source of income outside of my job. So for me specifically, I looked into covered calls and I thought to myself, okay, I'm also looking into real estate and just doing research in different asset classes. And what covered calls looked like to me was I put a small down payment on a growth stock that might be very volatile, that has high premium, and I think to myself, okay, I want 100 shares at $40 a share. Okay, that means I need $4,000 in order to start this. My down payment is $4,000 for the covered calls, and if it's hyper volatile, it was netting me anywhere from $400 to $500 of premium a month before I started going longer term. So that's a lot. That's a lot in premium for me because I was taking that and I was living on some of that. And then when I sold my shares and they went up and they did really well, I was reinvesting that back into my larger position to buy more shares so I can build up a larger portfolio for covered calls. And when I was fired from my job, I had gotten to a point in my portfolio where my share increase and my premium from covered calls was surpassing, plus some options trading, was surpassing my job income. So I was in no danger whatsoever, which was incredible, which is why covered calls for me are very, very important to my background as a trader. So I was trading stocks that a lot of people know. Riot, Mara. I was trading apps. Snapchat's got good premium. So I was trading around the $30 to $40 range. I got Mara and Riot and somewhere in the 20s, which was great, and I loved that. But the premium they were producing because of how volatile they were, my percent return on my equity purchases was just phenomenal. And for that percent return on top of it, I was able to actually live off of it. And I was getting 200 or 300 shares of Riot, 200 shares of Mara, for example. This was not a sizable portfolio. It wasn't even six figures. And I was just netting as much premium as I could and re-injecting it. And then when I sold my shares at highs, when Bitcoin ran up for the cryptos, for example, I was taking that profit and re-injecting it the next time it fell. And I was just cycling. And it was also a way that I could buy and sell different equities. And covered calls was another way that I also padded my taxes. That's another conversation.
Yeah, absolutely.
But on the other side of that, you asked me about what I do in regards to OBR, why I preach covered calls with my current style.
Yes.
So for covered calls specifically, I'm going to explain how this works first and ask any questions you think you might have as somebody who's never run them before. So we'll start with it this way. Guys, I'm going to make this very, very simple. Covered calls we're just talking about covered calls here, not covered puts. That's the other end of what this strategy is.
Just covered calls.
Right. So the strategy itself is called the wheel. And I'll get into the covered puts down after I explain the covered call section of this. So current standing, I use covered calls to add to my annual return of my 100 share increments of security and ETF positions. And I always cover my calls out of the money right around when stocks get to all-time highs. And that is because if the stock falls from there, I can close that covered call position for a good premium. And I can close that position and not owe anything to it. The contract is closed, meaning I do not have to sell my shares. Now, what that means is, let's go from the bare bones here. Covered calls are not a difficult concept to understand, so I'm going to try and be as simplistic as I can be. When you have a stock that's trading at $100 a share, you have to start out with, in order to run a covered call, you have to buy 100 shares of that stock. And that would cost you out the gate, that would cost you $10,000. So you look at the stock, you've got, and I always buy dips for my covered calls. I never buy them at all-time highs or even in the middle of their trading range. I always buy large falls. And tech sector from any given time could fall 10, 20% easily, right? And tech sector is hyper volatile. For ETFs, I'm looking for about 5 to 10% for my equity purchases. So, and quite a bit larger if the market provides it.
Okay.
So, for covered calls, stock X, Y, and Z is at $100 a share. And you think to yourself, okay, in 2 months, I believe stock X, Y, and Z will get to $120 a share. So what that means is, okay, if you want to maximize that 20% return, but you want to make a little bit more on top of it, but that's your price target for where you plan to sell it, you can go 2 months out in your options chain, and you can sell the $120 call or the $120 strike on the call side of the aisle. That will have a certain premium associated with it, of which, since you're selling a call, that means somebody's buying it.
Right.
Which means you are paid that premium. Now, the contract you take on when you sell that call, you are obligated at $120 a share at expiration to sell your 100 shares. So if you're 100, yeah, exactly. So if the share price gets up to 120 or above by expiration, you have made $20 a share, which is incredible. That's $2,000 profit, 20% return, and you get to keep the premium. But at or above 120 on expiration for that call that you sold, the contract states that you have to sell your 100 shares at that price at 120. So that is the very
Which is okay if it's your profit target.
Right, exactly. It's a great way, and that's also how I utilize debit spreads, which I talked about in the last video. If I were to ever get into a debit spread, I'm going to sell the call. If I'm doing a bull call debit spread, I'm going to sell the call at my price target, because that's when I stop making profit. Right? So that's just another way to make something cheaper for myself on the debit spread aisle, but also know when I look at the strikes and I see something $20 out of the money from my purchase call, the sold call is $20 out of the money, think to myself, okay, that reminds me. That's my target, right? That's what I'm getting out. So that being said, that is the very simplistic way of utilizing covered calls.
I was going to say that's very simple.
Right. It's very easy. It's very easy. And the best part about covered calls is if stock X, Y, and Z does not get to 120, you still took the premium for the 120 call. You still keep that. And you keep the premium regardless unless you close the position.
So you want to hold these until expiration?
Yes and no. It's a good point. So the way that I utilize covered calls now that I'm trading with multiple increments of 100 shares, is I will wait. I will buy in low for the equity that I want to hold 100 shares of. I will wait for it to retrace up into all-time highs, and primarily right now I'm referring to leveraged ETFs, and I love them. I absolutely love them, specifically SPXL and TQQ, for examples. So I will let those retrace. I will get in at 20, 25% down for those. Let it retrace up 20, 25% upon the retracement back up to previous all-time highs, and then I'll cover 6 months out. And once I cover it, I'll net, let's say, about $1,000 to $2,000 in premium, maybe 2.5 sometimes, depending upon how high it's moved up and the applied volatility and how high the premium is. So I'll go 6 months out, go $10, $20 out of the money, and that covered call now acts as a hedge. And I'm giving all the free game here. I'm giving everything I've got, and this is how I manage my portfolios on the covered call side. So I talk about it in the live calls, so I'm fine throwing it up here. I know it'll help you guys. And The rocket science behind it is knowing when to allocate and when to remove yourself from these positions. So the overall outline, very simple. Covered calls are one of the easiest things that I do. When I deploy those covered calls and I go far out of the money, I'm calculating in how much I want to make between the dip buy and the ceiling that my covered call is now created. Usually it's about $40 a share. So I get a substantial amount of premium covering it 6 months out, $20 out of the money. And then I come back around and I'm sitting here and I'm waiting. It's at all-time highs. Oh, it went a little higher, went a couple dollars higher. Oh, there's a 5% down. S&P 500 falls 5%. TQQ falls 17%. Those covered calls immediately start gaining value, somewhere around 30 to 40% range. Now that I've made 30 to 40% of the $2,000 in premium that I got, I close it.
But I was under the impression that you won't receive that premium if you do close it before the expiration.
Well, the contract gains inherent value because it's technically a bearish position.
Got it. So you're talking about just making a higher percentage on the actual options trade rather than the premium. Got it.
Yes. Well, so here's the thing. Here's how it works. When you sell a call at all-time highs, it's the highest that call is going to be, right? So you get credited, let's say $2,000. Let's say the underlying asset falls. That call is not going to be worth as much, right? But you were paid $2,000. But now that call is worth $1,000. So to buy it back, it only costs you $1,000, therefore netting you $1,000.
Understood.
So then you've already, from this trade in short term, you've gained $1,000. Okay, that's profit. You get to put that right in your, it goes right in your cash balance and is not touched. As soon as it retraces back, and also around this time, you could use that and dump it right back into the equity. That's another great thing to do. I always leave cash on the sidelines, so I'm always ready to buy my dips, period. I always got the chips on the sidelines, salsa's ready. Okay? So, that being said, you can re-inject it into equity so that you consistently on dips buying yourself back up to another 100 share increment, or you just wait for it to fall, close your covered call, get your 50% return, 40% return, wait for it to go back up, cover it again. And the reason why I haven't said anything about selling the shares on these bad boys is because these share positions are on ETFs that we all know and love and that we know do well year over year over year over year over year. Obviously, there's some very specific examples that have caused the entire market not to do well, right? All we can do is plan ahead. All we can do is plan ahead. So that being said, the shares will be sold as soon as I get into the long-term capital gains category.
Understood.
Yes, sir.
Okay. I had a lot of questions, but you actually answered all of those questions.
Beautiful.
So what do you think an effective way for somebody that is newer to covered calls to be able to start integrating them into their trading strategy today?
So if you would like a lower barrier of entry, go and look through a stock screener on Thinkorswim and look for something with very high implied volatility or very high premium with a low share price. For example, if you find a stock that trades like this, but has relatively been holding the same trading range for a year, for example, you have a whole list of supports where you can buy in your 100 shares and a whole list of resistances where you can cover your calls or sell your shares for a profit. So that being said, it just takes some research looking at higher premium stocks with a lower share price. For example, the ones that I used and loved the most, the stock that has made me more money in premium than any other stock before I started transferring over to the longer term premium strategy was APPS. I'm not recommending anybody to get it. I am not a financial advisor. I am not a fiduciary, blah, 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 blah. I'm not telling anybody to get it. That was the stock that made me the most amount of premium with my small budget. I bought it in between $30 and $40 and $50 a share, and there were times where it ran all the way up to 70, if not 80, if not 100, and then it would come right back down. it would just come crashing back down. And then because there's so much institutional money in it, they bring it right back up.
Right.
They bring it
So
right
you just
back
played
up.
that range with covered calls.
Yep. That is just a long-term range, and I just wait for it to happen, and then I click sell, covered call, net the premium, and I just play around with it. And I realized if I had done it on a longer term with apps, it would have done so much better. But I was doing it on a bi-weekly, if not monthly basis, because I needed the cash.
Yeah.
So.
Okay. Awesome. Thank you so much, Clayton, for your explanation on covered calls.
Yes, sir. I'm happy.